Let's be honest, the Bitcoin market just feels, well, it feels broken, right? The price might be doing okay, but the overall feeling, the sentiment is just overwhelmingly negative. So today, we're going to dig into that paradox using some incredible insights from on-chain expert James Check to figure out what is really going on under the surface.
I mean, if you're in this space, you've felt it. The vibe is just completely off. It feels like a bear market, just full of frustration and choppy, sideways price action. And it seems like pretty much everyone is asking this exact same question.
But here's the wild part, the paradox at the heart of it all. Despite all that doom and gloom, Bitcoin is actually up on the year. James Check calls this the modern bear market. It's a market where the price is technically positive, but everybody's salty and frustrated because it hasn't ripped up to the moon like they expected. And that sets up a really fascinating puzzle for us to solve.
Okay, so let's get into it. And the only way to really understand what's happening is to first look at the case for a crash. Because, to be fair, there is some very compelling data out there that completely supports all that negative feeling. So, the first major red flag is what Check calls a top-heavy market. Now, what does that mean? It means a huge amount of money has flooded into Bitcoin at very high prices. This has basically created this giant group of investors who are either barely in profit or, even worse, already at a loss. It makes the whole market structure feel really fragile.
And this chart, wow, it just paints the picture perfectly. A staggering 63% of all the wealth in Bitcoin has a cost basis, which is just a fancy way of saying the price it was bought at, above $95,000. Think about that. The majority of all the capital invested is sitting way up at these higher price levels, and that creates a pretty significant vulnerability.
And this quote from Check really drives home the consequences. If the price were to dip below that 95K level for any real amount of time, most of the market would suddenly be in the red. That creates this immense psychological pressure to sell. It also means there's basically no price history, no real support between 95K and the low 80s, which could lead to a really fast, scary cascade of selling.
And on top of all that, the selling pressure from long-term holders has just been relentless. This year alone, an absolutely staggering $290 billion worth of coins that were held for over a year have been sold or moved. So you've got a top-heavy structure and a historic level of selling. You can see why the bear case looks so incredibly strong.
But this is where the mystery really starts to deepen, because all of that selling pressure, logically, should have absolutely cratered the price. Sent it to the floor. And yet, it hasn't. Something else is happening, something we can't easily see.
This is the key question that James Check keeps coming back to. The bears have, in his own words, the most artillery firing that they've ever had. And yet, the price is holding steady. It's absorbing the hits. So, who in the world is on the other side of that trade?
Well, what we're actually seeing is a tale of two different markets playing out at the same time. On one side, you've got the sellers, the old guard, the early adopters taking their profits, and the traders who are convinced the old 4-year cycle is playing out like always. But on the other side, a totally new kind of buyer is soaking it all up. Patient, institutional capital, what Check calls forever allocators.
And here's the thing. These new buyers, they act completely differently. They are not chasing crazy price pumps. They're not creating that retail FOMO we're all used to seeing. No, they are sophisticated, and they're just quietly letting the market sell to them. They're not on Twitter bragging about their positions. They're just methodically, patiently absorbing billions and billions of dollars in supply.
So this massive, quiet, almost invisible transfer of assets from one group to another actually has a name. And it might just be the single most important theory for understanding this market's bizarre behavior.
This is what Check calls the Great Rotation. And it's not just another phase in the cycle. This is a fundamental, structural change in the market itself. All those old coins from early believers are being sold and distributed to a brand new, persistent base of demand that has simply never existed before in Bitcoin's history.
And when you break it down, it's a pretty simple 3-step process. First, the old guard, who think the top of the cycle is in, they sell off their bags. Second, this new guard of institutional capital quietly steps in and absorbs every single coin they're selling. And third, as a result of this massive transfer, the entire structure of the market is transformed for good.
Check has this absolutely fantastic metaphor to describe what's happening. He says Bitcoin has mastered its freshwater pond, its original ecosystem, and now it's in the process of swimming out into the saltwater, the big, bad, deep ocean of global finance. We're in that messy, choppy estuary right now, where the two different waters are mixing.
So what does this all mean for us? Well, if the market structure has fundamentally changed, if it's a whole new ballgame, then it means the playbook that we've all been using for the last decade might be completely outdated.
And that leads us to a pretty profound and maybe even controversial question. What if those predictable four-year cycles that we've all come to rely on, what if they weren't the permanent rule? What if that was just the bootstrapping phase to get the network off the ground, and now, as a true macro asset, Bitcoin is going to be driven by completely different forces?
You know, this isn't just a theory. We're actually seeing hard evidence of this structural shift in the derivatives market. Look at this. For the first time ever, the options market is now significantly larger than the futures market. And that is not a small change. It's a signal that a much more sophisticated type of investor is moving in, and it totally rewrites the mechanics of how price gets discovered.
See, a market that's dominated by options has totally new dynamics. It can lead to these things called gamma squeezes, where even small price moves can trigger massive chain reactions, causing sudden violent explosions in price after long, boring periods of quiet. To put it simply, the good old simple days are probably over. Okay, for the final piece of the puzzle, we have to zoom out. This great rotation, this huge internal shift for Bitcoin, it isn't happening in a vacuum. It's happening right as the global macro environment is looking more and more fragile. Checkpoints to a few potential triggers out there on the horizon, but the main one to really keep an eye on is the AI bubble. He makes the case that because these few AI companies are so central to the entire stock market's performance, when that bubble finally cracks, it could take the whole economy down with it. And an event like that, well, that could be the very thing that forces governments to turn the money printers back on in a big way.
And the logic here is pretty simple, right? In the world we live in today, the stock market is the economy. No politician, no central banker can afford to let it truly collapse. So a major crash, like the AI bubble popping, would almost certainly force their hand and trigger a massive stimulus response, probably one that makes what we saw during COVID look small. And this all brings us to the final, crucial point. As this great rotation of Bitcoin finishes, and as it solidifies its new role in the wider world of finance, it becomes uniquely positioned. So the question I want to leave you with is this. When the old financial world inevitably cracks under its own weight, what asset is going to be left standing?